I'd like to introduce Dan Cook from Nadex, who is going to discuss day trading gold and oil markets with knockouts and call spreads. Dan, it is all you.
Awesome. Thank you, Todd. Yeah, hopefully we don't run into any more technical issues today. You may have heard me mention, I'm going to do a brief presentation. I'm probably going to go through it pretty quick, but I want to spend most of the time in the platform. I'll try to answer the questions as they come across. We have a lot of people on today, and we've got a couple other people also attending to the questions. So hopefully we get everybody's questions answered. As Todd mentioned, this will be recorded. I'm going to be talking about knockouts and call spreads. They're actually pretty similar contracts. When we get into the platform, I'm going to focus on gold and oil, but the first part of this presentation will be more in general as to what are knockouts, what are call spreads. But real quick, just out of curiosity, is anybody on your currently trading gold, oil, both in the futures market? It's actually a market that not a lot of people have had access to. It looks like a few here, definitely. So we're going to be drawing some comparisons as well when we get into the platform. These are two contracts that are very near and dear to my heart, mostly because I'm biased because I designed both of them. Call spreads have been around a while, and while I designed the Nadex rendition, I basically just took an idea from the options market, pre-packaged it to make it a little bit easier for somebody who wasn't overly familiar with options to really get in and understand. So with that, let's go ahead and kick off the presentation, and then we'll hop into the platform. Before we begin though, quick disclaimer, you'll probably hear this quite a few times today, trading involves risk. It's not appropriate for everyone, and it's not appropriate at all points in our life. So always keep in mind that it should involve risk capital, right? It can't be money that's earmarked for groceries or rent. If it is the surest way to lose money in the market. It has to be risk capital, and it goes down to really the psychology of trading. If you're so dependent on day-to-day necessities with this money, step back, trade demo for a while. You can even paper trade a live account. We'll talk a little bit about that just a little bit later. You're always trading at your own risk. One of the things I love about Nadex is there are no margin calls. Anybody that's ever had one understands how painful they are, and even anybody that's ever had to make that call for more funds. Everything is fully collateralized. That said, you can lose everything that you put up for a trade. So I'm going to be placing some trades in the demo account. Please do not follow along in your live account and think, oh, Dan placed that trade. I'm going to do that. Absolutely not. These are going to just be for examples to show you the platform, how these contracts are structured, some of their nuances and things you really need to know. All right, so we're going to be covering knockouts, how they work, risk, reward, capital requirements. A lot of these things will be very similar from knockouts to call spreads, particularly with regard to risk, reward, and those capital requirements. And then we're going to go right into the platform. And before we begin, just because I know that we have some futures traders on here based on the responses, when we get into crude oil, we're going to spend crude oil and gold. We also have silver and natty gas. But they are based on, the gold is based on the CME GC contract, which is the COMEX NYMEX gold futures. And the Nadex crude oil contract is based on the sign CL, which is the NYMEX crude oil futures. So that's what we're going to be looking at when we get into what the underlying markets are in the platform. So let's start with the basics though, on knockouts. And both knockouts and call spreads are basically a range bound trade. It is a price range between two price levels, a low price level called the floor, a high price level called the ceiling. Pretty creative naming conventions there. Lowest floor, highest ceiling. Those are the maximum price movement or ranges within these contracts. With a knockout, it's going to move very linearly. So if you're used to looking at, say, CL or GC in the futures market, when you look at a knockout contract, it's going to move in an extremely similar fashion, virtually tick for tick. We're going to try to keep it simple. Really, any contract at Nadex, whether that be binary option, which Todd just covered, call spreads, knockouts. If you think the market's going up, you buy. If you think the market's going down, you sell. Pretty simple concepts. So with a knockout, they can expire in one of two ways. You can expire by price or by time. This is why they're called knockouts. So when you have a floor and a ceiling, and if you've been trading for a little bit, you may look at it almost like a predefined OCO order. So if you're long and it hits the floor, that's basically your stop, your guaranteed maximum loss. If you're long and it touches the ceiling or goes beyond, that contract settles at that price. We're going to get into some visuals in just a moment as well. If it doesn't touch either the floor or ceiling throughout the life of the contract, it will settle based on time at the end of the week. So typically a Friday, unless there's a holiday, and then it would potentially be a Thursday. This will be a variable payout, which we'll take a look at. So maximum duration of 1 week. We list 4 knockouts per market. If one of them gets knocked out, a new knockout contract gets listed. In almost all conditions, there will be 4 unique knockouts to choose from. So 4 different ones to choose from. This is an example on the US 500. So this is more general knockouts, but this is the structure of all the knockouts. We're going to focus when we get in the platform on gold and oil, but whether you're trading knockouts on currencies, indices, or commodities like gold and oil, the structure and the basic mechanics are all going to be the same. So at the beginning of the week, and if you see at the left where my arrow is, you can see a few candles there. That's the midpoint of the market. And so you'll see 4 distinct knockout contracts, each with their own floor to ceiling levels. So here's the midpoint, that blue line, make it a little bit easier to see. And then we have our end of week expiration, that red line on the screen. So if you pay attention, it might be tough to see here over the presentation, but you'll see the price move. So follow along right there. The price moved up to the level of the ceiling of this knockout. At that point, and I'm going to go back one, if you were short knockout number 4, meaning if you sold it right here at this price level, at that point, you'd be stopped out. It would automatically knock you out for your maximum loss. There is no slippage. So even if you get into a big market gap, you always know what your maximum risk is. Once that's knocked out, we'll move that one in red, a new knockout is created at a higher level. And if the market continues to move up and then knockout 3 is knocked out, another one will, and it'll go up in a stair-step fashion. If, on the other hand, the market moves down immediately on the open, you can see there this knockout was expired due to price. A new knockout will be created in a downward stair-step fashion. So as a contract gets knocked out, a new one's created. And we're going to take a look at the risk reward in a lot more detail and really trading examples when we get into the demo account here. So if none of them are knocked out, right? Meaning, and typically in any given week, depending on the volatility of the market, we could have no contracts knocked out, which is a very rare occurrence actually. Or if we look at last March when the markets were going crazy, and we'd see like 1,100 knockouts get taken out in a week. So depending on the volatility of the markets, it is a lot can be knocked out. But if we don't, we'll typically have 4 brackets going into the close as well. So let's just say that this happens. We have these 4 knockouts, right? The price is still all within the range of all of these. So right here, we'll say that's 27.80 on the ES. All of these knockouts will settle at the exact same price level. So if I sold up here, say at 28.20 on knockout number 1, it expires by time, say around 27.80. I picked up my 40 points less exchange fees. So this is actually a great question, which I want to address right away. So, and I'm really glad you asked this, Mike. The question is, planning to offer knockouts for intraday and daily contracts? No, and the reason is it doesn't matter. You can day trade these as easily as you can trade them. Just because they're a week long, all of the contracts are structured and we'll get more into depth in this, so that you can get in on a day trade with low risk and have high potential return. So you don't have to hold on to these for the week. So if you're a day trader, you'll still be able to find great opportunities in these, because you'll just close them out just like you would in futures, right? Even though a futures contract, often depending on the month, either goes, well, they're listed actually for more than that, but let's say when they're the front month, they're anywhere between a month long to 3 months long. So just because you have an oil contract, a futures contract that's 90 days roughly in duration, most people aren't holding that for 90 days. That's just the length of the contract, but you still have opportunity on an intraday and daily basis to do that. So just want to make that very clear, because we are talking about day trading today, and I think these are very suitable for that. So we're going to cover risk reward in the platform when we get in there. Really, what these floor to ceilings and a knockout do is give you natural boundaries. They provide a natural profit target, but also defined risk control. A lot of times, we refer to them as a built-in trading plan, right? So you have your maximum exit and maximum potential profit built in, sort of discipline for when you don't. Yeah, I covered this, profit target, stop loss. On the risk side, so this is pretty easy. If you're buying, your maximum risk is the difference between where you buy and the floor. On the sell side, your maximum risk is the difference between the ceiling and the basically where you sold. Reward side is just the inverse, right? So we're going to be looking at these contracts, and we'll talk about the full contract value and what you'll be looking for when you get into there. And just looking at some questions here. Right now, there's no plans to offer more than 4 KOs. I'm going to cover that one more in depth as we get into the platform as well, which is why, if you haven't noticed, I'm kind of rushing through this presentation a little bit because it's going to be recorded. And I think really the most important thing, as my father used to tell me, he could tell me all about whether that be, redoing a hardwood floor or changing the tire on a car, but until you actually do it, it really doesn't make a ton of sense. And yeah, with Robert, with these knockouts, they're moving in linearity. They move just like the underlying market does. So whether you're trading index futures, currencies, commodities, if you're day trading the futures contracts, you can day trade these in really virtually the exact same manner. And we'll talk about call spreads. So let's just do a quick risk reward. We're going to say if I bought this is my range. This is a range of 50 points on this particular contract. It's $10 per point, so a $500 contract. Wherever I buy, and this is going to be the same for the call spreads, even though they function a little bit differently. If I buy here at 27.20, my floor at 27.10, my maximum risk is $100. My maximum return is $400. Again, I don't have to hold it until expiration. If I am selling, so let's say I was selling this one, just the inverse, right? I am placing a sell order here. My risk is the difference where I'm selling and the ceiling. So that red represents my risk. The green represents my profit objective. Capital requirements, it's always known before the trade, and it's always equal to your maximum risk. So in the previous examples, you're going to, in the previous examples, you'd be putting up basically $100 in collateral to trade one contract. The risk on both of those was $100. It varies though. We'll look at that in the platform as well. One of the great things about these, and I know we saw that there were a few people trading futures on here, is the capital requirement never changes. So if you are, let's say you had a decent sized move and you're in profit, but you're coming up to the close of the market. And if you're not familiar, there's this thing in futures called overnight margin. So it's basically over the close period of the exchange. Margin requirements escalate really quickly. So it's very difficult, particularly with someone with a smaller account, to hold positions through that close. The capital requirements on a knockout never change. Buying and selling are the same from capital requirement perspective. And really the whole design of these is to minimize capital requirements, allow you to get into a lower cost of capital, but still have a lot of, you still have a lot of upside opportunity. So call spreads. Call spreads are virtually identical to a knockout, with the biggest thing is that they don't get knocked out. It does move somewhat in line with the underlying markets, similar to knockouts, but with call spreads, we're going to introduce a concept called optionality. So if you're not familiar with options, don't worry about it. We'll take a look at what that means from the perspective. But they do, just like a knockout, it's two levels, floor and ceiling, same risk reward parameters from when you're buying, but these only expire at the given time, at the expiration time. So they're never knocked out. So I don't know, has anybody ever been trading and you're going along and you get into a trade and all of a sudden, let's say you get long and you throw your stop out there and the markets look like it's the perfect setup, and all of a sudden, bam, the market goes down, stops you out, and then as if it had eyes, it shoots off like a rocket. Yeah, it happens to everybody, right? You're knocked out of the trade. That never happens with call spreads. One of the reasons why I love, why I think they're very valuable, particularly in a lot of situations. So real quick, so there is really no delta in a knockout, but there is a delta which we'll cover in the call spreads. And if you're not familiar with that term, we'll walk through that in more detail when we get into the charts. I'm much more of a visual person. I don't know about anybody else. Unless I can see it on a chart, it doesn't really work for me. You know what? A question came up regarding scalping. You can definitely scalp a call spread, but there's some nuances to it. And I think from a scalping perspective, I would actually lean towards the knockouts. If you're a very short-term trader, and we'll get in and explain how that movement really takes. But if I'm a very short-term trader, and this goes for everybody, I would really look for the knockout type of contract to do that. And I'm going to be on top of the market, right? If I'm scalping, I am sitting there and I've got my strategy set up so that if I'm wrong, I get out quick, and if I'm right, I can try to maximize that. So with a call spread, so volatility doesn't impact a knockout. Time doesn't impact a knockout option. Volatility and time to expiration do impact the price of a call spread. So you have what's called premium. If you think about it this way, if you were insuring your car for a month, right, for 1 month, the premium for that 1 month is going to be much less expensive than a premium if you were paying up for the whole year up front, right? Just probability wise, you have more probability of being in an accident in 12 months than what you do in 1 month if, with consistent driving. You also have more time. And so the more time, the more volatility. A lot of times the call spreads can become a little bit more expensive. They don't move as fast as such. What's interesting is kind of a general rule of thumb, and I did this in our previous one where I was talking about volatility. If we have really crazy volatile markets, and let's say, I mean, if we went back to something like last March, it would be really difficult to trade a call spread contract. And most people would look to the knockout option because it's not so heavily impacted by volatility. But under lower volatility and more normalized markets, the call spreads can offer a lot of advantages. And so we'll walk through some of those as well. So again, just because there's an expiration associated with this, you don't have to wait till expiration. You don't have to wait to see what happens. You can always close out early. One of the first things one of my mentors said to me, this goes back, 2004, I think, 2004, 2005, when I was working with him. He'd been trading about 30 years at that point. And he said the only difference between him and a pretty green trader was that he got out of his losing trades faster. So just because you have that built-in protection, and this is whether it be a binary option and knockout, a call spread, just because you have that built-in maximum loss, if the market starts moving against you, if it's not doing what you thought it was going to do, there is nothing wrong with cutting your losses early. Now, one of the great things about a call spread is that you can actually buy time to be right. You're letting the market work rather than timing the market, because you have that built-in protection that never stops out. You can remain in the trade for a much longer time, yet still have great risk management. So I'm going to hop over to the platform. All right, can everybody see that platform? Okay, perfect. I'm going to take a quick sip of coffee and a quick sip of water, and I'll continue. All right, so one of the things that makes this the new platform, I know, so I recognize some names that have been around with us for a while. The old platform didn't do a good job of a visual representation of either knockouts or call spreads. So at the top, I'm going to go to knockouts. And if you're new to these, I would definitely recommend practicing in demo. Unfortunately, Robert, I don't think I can magnify via the GoToWebinar. So one of the things, though, we're going to do this walkthrough. When the recording comes out, I believe you'll be able to expand the recording. I don't think I can live through this on the platform. So on knockouts, I'm going to go to commodities. So we're getting kind of late in the day here, really for call spreads on the commodities. The other contracts go a little bit later in the afternoon. But on the knockouts, right, because they're a week long and they move linearly. So let's take a look. I'm just going to walk through a few examples. So right now, and I'm just going to click on and bring up an oil chart. So right now, we've got oil trading around 65.70 is the thing. So I'm not going to do a ton of analysis. I want to remind you, do not place trades along with me in your live account. I do recommend working on these at demo. Now, a demo will never teach you how to trade. My motto for a long time is, when you practice in demo, you practice to understand how the contracts work. You practice to understand the platform. But demo is all about practice. You'll never learn to trade until you trade live. And if you learn to trade live, start out small, take your time, right? But when you put real money in the market, a demo can never replicate, even if it was identical to the live market, which virtually none of them are. You'd still never learn to trade, because the psychological ramification of losing money is much greater than just learning. So let's say that we thought that we're double topping. I'm just going to say, hey, we're looking at double topping, so we want to sell. So right now, crude oil is at 65.72. If I want to sell, as you can see, I have multiple ranges here on the left. I'm going to choose the range in this case, and I'm going to click on that right here. So let me just shrink my chart a little bit, because you can see these are wide ranges, right? Does everybody see those blue lines on the chart? So if we're selling, this is the ceiling, top blue line. This is the floor. If I sell, and if I sell one contract, right now I am 58 ticks from the ceiling. So $58 would be my collateral required. You'll see that on the order ticket right over here. So I know we've had some few people. So if you're trading the CL, which is a pretty big contract, it's $1,000 a point. If you wanted to do the equivalent, that would be 10 contracts to do the same per point equivalent, right? So it's basically $10 per tick with 100 ticks in a point. So right now, if I wanted to do the equivalent of a standard oil contract, I would have to put up, in this particular scenario, $570 in collateral with a maximum potential profit of $4,490. To give you an idea right now, if you looked at day trading margin on CL, most brokers are around $1,300. However, if I wanted to hold this, let's say I got the move I wanted and I wanted to hold it through the close, I would have to then put up $5,300 out of my account if I was trading oil. But on these knockouts, that never changes. So if I get into this trade right now, $550 risk, I'm just going to place this order for 10 contracts. So placed it. It's in my open positions. So now we have our position on. I could walk away at this point and just say, okay, well, if it hits there, I'm knocked out for my loss. You know, I lose my $550. So, and basically I could trade this. I could trade a single contract for $55, right? That's the way these are designed. Now, if I wanted to trade, if I wanted to sell this one, I'm going to have to put up a lot more. The ceiling's a lot farther away. If I wanted to buy, I'm going to choose the contract where the price is closest to the floor in most cases. Now, if price was right down at the floor, it might not be enough room to breathe. So I might want to take the next contract. But so we're in our oil position, and I'm going to go back to this one. Now, I wouldn't want to walk away, even though I have my trade set up here with my maximum risk and maximum potential return. I don't want to walk away and have the market say drop down. I'm just going to draw a line. I don't want to have the market do something like this and then walk back to only find out it did this, right? That wouldn't do us any good. So I have a low risk already set up here. And if I'm scalping this, by the way, CL is just the abbreviation for the underlying market. It's the CME crude oil contract that this contract is based on. So if you are trading crude oil and you hold a Nadex chart against a crude oil chart of the same time frame, it'll be virtually tick for tick. So what I want to do in this scenario is I'm going to set a limit order. So to set a limit order, we've got a cool new feature coming out in just a bit, but for right now, I'm going to click crude oil. It's going to open up my order ticket in the opposite direction. What I'm going to do is I'm going to change this to limit, and let's say I'm going to take off 5 contracts if the market goes to $64. Place order. So now, if the market goes down here to 64 and goes past, I'm gonna have my limit order to take some profit, and I could set up multiple limit orders down here. I could take off 3 here, 3 here, 3 here, and let the last one run. But I want to be locking in profit along the way. I've always got my maximum risk defined here. And so somebody was asking about scalping. So again, this is in demo, but a second ago we were up, we're up $60, $70, and we've been in this trade about 2 minutes. So it is very possible to scalp. We already covered the bid offer spread. Now we're up $80. So we made what? Now we're up 90. So the question about scalping, because this underlying price, whether this be in demo or in the live, the underlying indicative is the same. So you can see in just a short amount of time, now granted I traded 10 contracts, but when we put up $1,500 and we were up, we put up $500 and we were up 90, 100 in just a matter of minutes, we can get a pretty good return on capital. Now we can also lose 90 or 100 just as quickly. But if you're a scalper and that's what you're used to, so the price action for a knockout really doesn't differ. Where you'll see the biggest difference, but what'll happen, Robert, is the underlying market won't really differ. What will differ sometimes is the bid offer prices. For example, if Nadex has market makers in both demo and live, if the markets are really volatile, and while volatility doesn't impact knockouts, you might see them go a bit wider on the live market, which happens in all markets in volatile times, where they don't necessarily adjust demo. Because when the markets are volatile, if you were a market maker, you'd want to be protecting where you actually have real cash in the market. So there will be slight differences. Now that said, you can always open up a live account. You can fund it. You don't even have to trade it in real things. But demo accounts pretty much across the board will always be slightly different. Yeah, Leonard, we'd love to. We've looked into the stops. Where they get really tricky is with binary options, but it's been something that's on the roadmap. I just don't have a I just don't have a good time frame on that. Because I agree. I think particularly a stop and a trailing stop would be fantastic on this. Let's flip over to gold and just see what we see. So gold currently, I'm just going to open up a chart. Gold's trading at 1775. So what I'm going to do is look for contracts. So right now I have one with a floor at 1770. So we're going to look at a buy on this particular one. By the way, again, general rule, if you're looking to buy, just by order, you'll look for the top bracket here, the top knockout. If you're looking to sell, you'll look for the bottom. But let's walk through a buy, and I'm just going to place one contract. So right now, this would be the equivalent to what's called the micro gold contract. Yep, this is definitely being recording. Yep. And so right now I can buy this. There's really a tick difference here. I'm just going to buy one contract. Just to give you an example of, and this is what we mean when we say we're designed for the individual trader. If I wanted to trade a gold contract, right, I would have to, if I wanted to trade a micro gold contract, meaning $1 per tick, I'd have to put up $250 in margin. And if I wanted to hold it through into overnight, I would have to put up $1,000. I can get into this trade right now for $46. So I've put up 1/5 of the capital. I've got guaranteed risk management, no possibility for slippage, and I can't get a margin call. And so I can trade these from a very low cost of capital, and I can also scalp them. And yes, we are thinking about adding stops. It's actually been on the roadmap for a while. It became a bit more of a project than we expected. So it's taken a bit longer, but yeah, that is something that has been on my wish list for a while. And I know we had a few questions about scalping. If we look down here at our current orders, I mean, gold hasn't moved much, but we're up $120 on our oil contract. So they can move very fast. They're going to move just like the underlying market. So while these are week-long contracts, if I wanted to say, you know what, I'm scalping this, I'm going to close out. I'm just going to close out of my crude oil contract. I'm going to click place order. And now I'm out of that. Now, one thing I always want to make sure, right? Remember, I put a limit order on that. So I'm going to go in and I want to make sure I delete this order. I don't want one just sitting out there. So real quick, I'm going to walk through this knockout again real quick from a risk reward perspective. Again, if I'm buying, the difference between where I buy and the floor, that's my maximum risk. If it hits this floor, I'm going to get knocked out of that trade, right? If I'm buying, I take it for a loss, boom, I'm knocked out. If I'm selling, I'll want to find something that's a bit closer to the ceiling. So in that case, I'm going to choose that bottom bracket. Let me just move my charts here a little bit, right? And so I can see it actually, we had a pretty good drop in gold here earlier today. So we're a little ways away from the ceiling, but we could still trade it at roughly, about not quite a 2.5 to 1, or excuse me, about a 2 to 1 risk reward from maximum loss to maximum reward. If we just wanted to scalp it, we'd sit here and scalp it. So again, pretty simple. If it hits either of these, it's going to knock out at that level. So if I sold here, goes up, hits 1790, that's where I'm knocked out. If it starts moving against me though, I can always close it out. So let's take a look at call spreads. And I'm just going to move to the commodities. Now we're getting late in the day for these. If I was looking to scalp at this time of day, I would actually probably look to knockouts in almost all scenarios on that. But very similar premise. I'm going to be looking to buy at the lower end of the range typically, sell at the higher end. And so right now, 65, it's trading right about 65.60, we'll say. So if I wanted to buy this particular contract, again, I'm going to look towards this upper one here. It's trading at 65.60. Let me get rid of these lines from our previous example. So the call spread range will actually be represented a little bit differently on the chart. It might be a little bit harder to see, whereas we had thick blue lines on the knockout. This is the call spread. You should notice some it's very, very similar. Floor, ceiling. So if I wanted to buy this contract right now, because there's not a lot of time left, I can actually buy it right about where the market is. If you notice though, right now, and again, this is demo, so it'd be a little bit different in live. 65.60, the market's trading at 65.50. So even the bid or the sell price is a bit above the market. That's a small amount of premium. So right now I can buy this contract at about 63 bucks with a potential return of 440. I'm just going to place this order. Now, here's one of the things that I think is great about a call spread. If the market does this, and bear with me, I'm just going to do, if I was trading this outright, right, I would typically, let's say that blue line is my stop. If the market moved down like this, right, I get stopped out. I don't know if that's ever happened to anybody. I'm sure it's happened to more than a few on the call. But the great thing with a call spread, and the thing I love the most, is let's say the market does that, and I don't know if this ever happened to anybody, and then it goes like this, right? In the regular markets, we were stopped out here, and with a knockout, we're knocked out of the trade, hence the name. But with a call spread, we're paying a little bit of premium for that protection. That's why we pay a bit of premium on a call spread. Again, very high volatility, you might pay a lot more premium. Or if there's a lot of time to expiration, there might be more premium. And the combination of the two means even more. But if we bought this one, as we did, and I'm just going to do this, if the market drops and goes below the floor, it doesn't matter. We still have, we call it buying time to be right. Now, if the market stays like this and stays flat, we're below the floor, but it expires at this price. Right? If it comes up like this, and let's say that this is our expiration right here, that white line. If it expires right here, and we'll just run through it, let's say that's at $68. We bought at $65.61, so we'd make the $2.19 less exchange fees, which would be $1 per contract, and then in this case, $1 at expiration at that level. So with both of these contracts, they're really structured to provide low cost of capital, minimize your risk, while still providing great upside opportunity. And that's really the key here. Again, I love the call spreads in more normalized markets. I think so here's a question. I have if you have 42. The question is, I have 4,250 at risk. Whatever your risk is, and I'll walk through this again. Whatever your risk is what your, or excuse me, whatever your risk on the trade is, that'll be your capital requirement. So let's walk through another one right here. We've got gold. I'm just going to say, so it's at 1774. I'm going to do this. Right? This price is actually a bit outside the range, but I can buy it relatively cheap. So right now, if I buy this contract at 1776, I've got $17 maximum potential loss, right? Because I'm actually buying it slightly above the floor. And this will actually give a good example of what I mean by optionality. So we're actually buying it right about there where that green line is, even though price is down here. So from the floor to here, that's your optionality. That's your maximum risk. Now, if I move to a contract, let's just see this one. So now I'm more in the middle of the range. Now I've got more of a 1-to-1 risk reward ratio. So now I'm right in the middle of the range. Now in the middle of the range, this contract is going to move much, much more like a knockout. It's going to move much more in linearity with the market. Where you really run into optionality is near the floor and near the ceiling. In the middle, it typically moves in more linearity. But as price moves up, price will move tick for tick for tick for tick for tick for tick. And then as it gets up in here, it'll start to slow down as it hits the ceiling. And again, as it moves towards the floor, it'll slow down as it moves towards the floor. So you might have to pay a few more points. But whatever your collateral required is whatever the risk on that contract is. So if I buy this one and it's $19 total risk, if I put this trade on, $19 risk, that's never going to change until this contract is actually expiring pretty soon. So I actually wouldn't make this trade because it's actually got to cover quite a bit of movement in a very short time to get to that in what's typically a pretty slow time in the market. A lot of times I would look towards call spreads earlier in the day. Well, really just markets in general. I mean, when we see really the most activity in the markets, is really going to be in the late early U.S. morning hours, particularly when Europe is still online and Europe is coming online. I know a lot of people that trade from like 7 a.m. Eastern to about 10 a.m. Eastern. That's their trading time. And you can go look at the markets. You can determine what's right for you. One of the great things, Todd covered binary options. One of the things I think are great about binary options is that just by the virtue of their short-term nature and their pricing, even if the actual markets aren't moving, the binary option itself can exhibit a whole lot of movement. Whereas a call spread and knockout is going to be much more dependent on activity in the markets. And so oftentimes a good time to look at them is in the morning. Now that said, I'm just gonna, I don't want to run too long here because I want to give everybody a break. One thing that you could look at, and a lot of people will look at the markets at night. And so at night, you pay a bit more premium in the crude oil, or look early in the day, you might pay a bit more premium. But when these contracts reset, when the call spreads reset in the evening, you'll typically be very close to both a floor and a ceiling, where you can go long or short. You can do something that's called direction neutral, meaning you don't know which way the market's going to go, you just expect it to move. There's also one I did, and I think Todd will probably show the Nadex webinars where you can find them in a bit. One I did called a binary option strangle, which walks through that. I'm not going to say the best time is 8 a.m. to 10 a.m. What I'll say is that a lot of the volume, in all markets, happens in the morning, particularly when we're looking at like commodities and futures, when you've got all the shops in the UK and Europe still actively trading, and you've got all of the US shops coming online at the same time, you just tend to get more movement. No guarantee. I mean, there are times where you can see great movement at 2 in the afternoon, much more rare, but I do know a lot of people prefer the mornings. But I mean, one of the great things I think about Nadex is I know a lot of people that trade overnight. So they put the kids to bed at like 9 a.m., they hop on and they start looking at the markets, you know, they've got a little bit of free time and they actively trade. And depending on the strategy they're using, they might place their positions on and go to bed, wake up in the morning, check the positions because they knew what their defined risk was. And with that, I ran a minute over, so apologies for that. Glad we didn't have any technical difficulties on my watch. Just busted on you a little bit there, Todd. But I'm going to let Todd take it over from here. This has been recorded. Hopefully I didn't just confuse the heck out of everybody. But been a great group. I really appreciate the questions. Yeah, so if you're still having trouble with the call spreads, go into the demo and actually trade them. Like, just take a look at the demo. It won't teach you how to trade, but it will teach you all of the mechanics of those. And really, the call spread at Nadex is it's just like a call spread in the options world, only it's packaged as a single unit. So instead of choosing where to buy a call, where to sell a call, and creating that range on your own, the ranges are predefined by historic market movement by the exchange. So you just need to decide buy or sell, and if the price is applicable to you. But again, there are some nuances. So, all righty, Todd, thank you very much.
Dan, thank you so much for that. As a matter of fact, you know what? Because people are asking, And so I am going to just show quickly. If you go to the learning section of the Nadex website, you go down to webinars, you click on webinars, you'll see the upcoming ones that we've got. All right, so if you are looking for a deeper dive into the trading platform, we do have one next week. But in the archive, if we click on there, this is where you'll find all of the recordings. So if you've never been introduced to technical analysis before, you can come and you can look at it. There are a variety of archived webinar content where you can get a deeper dive into any one of these our products. If you're curious more about call spreads, knockouts, it's all available up here. So this is also where you will find the recordings from this show. So I just wanted everyone to be able to see that. That is, if you're looking for additional resources, you'll also find a lot of content on the YouTube channel, on the Nadex YouTube channel.